Okay, we are doing application problem 8-2 on page 225. Read several years ago, PTR purchased business equipment for $50,000. PTR's accumulated book depreciation is $37,200, and accumulated tax depreciation using makers is $41,000. So part A, compute our book and tax basis on the equipment. So for our book basis, we're going to take our $50,000 cost, subtract our $37,200 accumulated depreciation, and that's going to give us our basis for on the books of $12,800. Okay, for tax purposes, we have the same cost of 50. We have accumulated depreciation of 41,000, giving us a tax basis of $9,000 for tax purposes. Okay, so let's look at Part B. Part B, we are using a 35% rate. Compute our deferred tax asset or tax liability resulting from the difference between our book and accumulated depreciation. Well, our tax depreciation is 41,000. Our book depreciation is 37,200. So we've taken more depreciation expense than what we have under the books by $3,800. Okay, so $3,800, we've had more deductions there, so that's going to be a favorable rate. Oops. 35, that was supposed to be percent. There we go. So my deferred tax liability is going to be that $3,800 excess gain times my 35% rate, gives me $1,330 of a deferred tax liability that I'll be carrying on my books. Okay, so let's look at Part C. We sell the equipment. So my sales price is $14,750, and that's the case under both methods. My book basis was $12,800, giving me a gain of $1,950 on our books. My tax basis, though, is $9,000, as we computed above, giving me a $5,750 taxable gain. Okay, so we have a higher taxable gain than we do an actual book gain. So what's that mean? Well, that $3,800 difference, what is that? Well, that's basically the depreciation that we had taken before. So as we pay that and we pay the tax, that will eliminate the $1,330 tax deferred tax liability that we had mentioned above. So that is just the basis of a simple calculation of tax basis and considering the taxable gains and losses for each.